Here's something most people get wrong. The Fed does not set your mortgage rate. They cut rates, and everyone expects mortgages to drop, but sometimes they actually go up. Today I'm explaining the real relationship between the Fed and your mortgage because understanding this could save you a lot of frustration. Hello, I'm Frank Kenny with Living in Los Angeles, South Bay. Today we're clearing up one of the biggest misconceptions in real estate, and that's the relationship between the Federal Reserve and your mortgage rate. This is something every buyer and homeowner needs to understand, especially right now. Before we get into it, make sure you like and subscribe so you always get the inside scoop on the housing market. Here's the biggest misconception about mortgage rates. Every time the Federal Reserve makes a move, I get calls and messages from buyers asking the same question. The Fed just cut rates, does that mean mortgage rates are going down now? And I completely understand why people think that. It seems logical. The Fed cuts rates, borrowing gets cheaper, mortgage rates drop. Simple, right? Well, except that's not how it works, and not exactly. And if you're making a buying decision based on what the Fed does, you could end up waiting for a rate drop that isn't coming, or missing an opportunity because you didn't understand what's really driving your rate. So then you might ask, what does the Fed actually control? Well, the Federal Reserve sets something called the federal funds rate. This is the rate that banks charge each other for short-term overnight loans. It's a behind-the-scenes rate that most people never deal with directly. When the Fed raises or lowers this rate, it affects short-term borrowing costs. Credit cards, auto loans, home equity lines of credit, those are more directly tied to the Fed's decisions. But here's the key point. Your 30-year fixed-rate mortgage, which is the most common type of home loan, does not track the federal funds rate. It tracks something completely different. Well, then what actually drives the mortgage rates? Well, fixed-rate mortgages follow the 10-year Treasury yield. When the 10-year Treasury goes up, mortgage rates tend to go up. When it goes down, mortgage rates tend to follow. Your mortgage rate will always be higher than the 10-year Treasury by a margin called the spread. The spread reflects the risk that lenders take on when they give you a 30-year loan. The more uncertainty in the market, the wider that spread gets, and the higher your rate. This is exactly why we saw something that confused a lot of people. At the end of 2024, the Fed cut its rate 3 times, a total of 100 basis points. But mortgage rates stayed above 7% and even went up at times. Why? Because the 10-year Treasury doesn't follow the Fed down. Inflation concerns and market uncertainty kept Treasury yields elevated, and mortgage rates reflected that. Now, beyond the 10-year Treasury, there are 3 other forces that influence what you'll pay. First is inflation. When inflation picks up, interest rates tend to rise across the board. Lenders need to charge more to make sure the money they're getting back is worth something after inflation eats into it. This is a big reason rates have stayed elevated even as the Fed has been cutting. 2 is supply and demand for mortgages. When lenders are swamped with applications, they raise rates to manage the volume. When business is slow, they cut rates to attract more borrowers. It's basic economics, and it happens independently of what the Fed does. 3 is the secondary mortgage market. Most lenders don't hold on to your mortgage. They bundle it up and sell it to investors as a mortgage rate-backed security. When investors' demand for these securities is high, lenders can offer lower rates. When investors aren't buying, rates go up to attract them. Global economic conditions, geopolitical events, and investor sentiment all plays into this. Now, there's one exception in mortgage rates, and that is the adjustable rate mortgage. This type of mortgage that is more directly affected by the Fed, adjustable rate mortgages, or ARMs, A-R-M, is if you have an ARM, your rate resets periodically, usually annually or semi-annually, and it's often tied to a benchmark so-called SOFR, which is influenced by the Fed's rate decisions. So if the Fed raises rates, your ARM rate will likely go up at the next adjustment. If they cut it, it could go down. That's a much more direct connection than what you see with fixed rate mortgages. This is important to understand if you're deciding between a fixed rate and an adjustable rate loan. With a fixed rate, you lock in your number and the Fed's moves don't touch you. With an ARM, or adjustable rate, you're along for the ride. Now let me quickly walk you through the last few years so you can see how all of this has played out in real time. Now, during COVID, the Fed cut rates to near zero. Mortgage rates dropped to historic lows. The 30-year average bottomed out at around 2.97 in early 2021. Those were incredible times to lock in a rate. Then inflation surged, and the Fed started raising rates aggressively in 2022. The federal funds rate hit 5.33% by August 2023, and mortgage rates breached 8% in October of 23. That was actually very painful for buyers. Since then, the Fed has cut rates several times, but mortgage rates have come down slowly. They hovered between 6.8 and 7.1 for much of early 2025 and dipped to around 6.09 in February 26 and have recently settled back above 6.25. What's the takeaway? Well, the Fed's moves matter, but they're just one piece of a bigger puzzle. Mortgage rates have their own trajectory. Now let's talk about what you can actually control. You can't control what the Fed does. You can't control inflation or the bond market. But there are things completely within your power that affect the rate you get. First, maintain strong credit. A higher credit score gets you a lower rate, period. Next will be keep your debt low. Your debt to income ratio matters to lenders. And next would be make the largest down payment you can. More equity means less risk for the lender. And then shop around. Different lenders offer different rates on the same day for the same borrower. Get multiple quotes. And last, compare the APR, not just the interest rate. Some lenders advertise low rates but load up on fees. The APR tells you the true cost. That's the annual percentage rate. So what's the bottom line? The Federal Reserve influences mortgage rates, but it does not control them. Your 30-year fixed rate tracks the 10-year Treasury, and it's also affected by inflation, lender supply and demand, and the secondary mortgage market. If you've been sitting on the sidelines waiting for the Fed to cut rates so your mortgage gets cheaper, that is not a reliable strategy. The Fed cut rates 6 times since late 2024, and mortgage rates are still above 6%, pushing 6.5 at this recording. Now, waiting is a terrible strategy. Instead of trying to predict the Fed, focus on what you can control: your credit, your debt, your down payment, and shopping around for the best deal. That's where the real savings are. If you want help navigating this market or want me to connect you with a mortgage broker who can get you the best rate that's available right now, reach out to me. And if you're an agent and have questions about this topic, please reach out to me as well. Please like and subscribe so you're guaranteed to get all of our helpful videos. And please feel free to share these useful videos with your family and your friends. Well, I'm Frank Kenny with Living in Los Angeles South Bay, and I'll see you on the next video.